They see your stop loss. They need your stop loss, and they're coming for it. Have you ever taken a trade, placed your stop loss like every textbook says, only to watch the market slam into your stop, then reverse in the direction you originally predicted? No, you're not cursed. You're not unlucky. You've been hunted. This video is not about tips or tricks. This is an exposure, a psychological and structural autopsy of how institutions, the real smart money, target you. Not by chance, but by design. Let me walk you into the jaws of stop-loss hunting. And more importantly, how to walk back out alive. Let's define this monster first. Stop-loss hunting is a deliberate price move by institutions to trigger the stop losses placed by predictable retail traders. Why? Because your stop loss is their liquidity. Every stop loss is a market order waiting to happen. It's like money lying on the table. Institutions need that money to enter or exit their own massive positions without causing slippage. They don't care about your emotions. They care about execution. And stop losses are the blood banks of liquidity. Quick fact, stop losses convert into market orders upon trigger. That means guaranteed execution, but not guaranteed price. In volatile moments, that stop loss you placed for protection becomes a slaughterhouse. Now that we understand what stop loss hunting is, let's step back and look at where it all began. This strategy isn't new. It's been around for decades, long before algorithmic trading ever existed. In the early days, on trading floors, big institutions and brokers would watch price levels where retail traders commonly placed their stops, usually just below obvious support levels or round numbers. All it took was a few large sell orders to push the price down, hit those stops, and trigger a wave of selling. That flood of orders gave them the liquidity they needed. And just like that, they'd buy in at the lows and ride the price back up. Simple, but effective. Fast forward to today, and stop-loss hunting has evolved into a much more sophisticated game. With high-frequency trading, advanced algorithms, and real-time data, institutions don't just guess where stops are, they know. They map out liquidity zones, hunt clusters, and execute with surgical precision. It's become a constant arms race. As retail traders, we can't rely on fixed rules anymore. Markets are changing, strategies are evolving, and we need to stay one step ahead. Let's talk about why stop-loss hunting hits retail traders the hardest. And it's not just about losing a single trade. See, this tactic is designed to do more than just knock you out of a position. It plays on something deeper, your emotions. When your stop gets hit, especially right before the price moves in your favor, it triggers frustration, doubt, even anger. And that's where things go wrong. You might try to jump back in without thinking clearly, chasing the move you almost caught, or worse. You start revenge trading to get your money back. Sound familiar? But here's where it gets dangerous. After getting stopped out a few times, many traders start reacting emotionally in the long term, not just in the moment. Some widen their stop losses too much, trying to play it safe, but that just increases their risk. Others stop using stop losses altogether, and that's a recipe for blowing up your account. It's not just the money lost, it's the mental toll and the damage to your discipline and risk management. Once you lose confidence in your own system, it's easy to spiral, jumping between strategies, ignoring rules, and stacking up bad decisions. So yes, stop-loss hunting matters, not because it's unfair, but because it tests your emotional control, risk discipline, and ability to stay rational in a market designed to shake you out. And the traders who survive, they're not just technically skilled, they're mentally prepared. To truly protect yourself from stop-loss hunting, you first need to understand how it actually works behind the charts. Let's break it down, one step at a time. How stop-loss orders work. Stop-loss orders are meant to protect you. They're automatic instructions to your broker. Sell my long position if price drops to this level, or buy back my short if price rises to that level. Once the trigger price is hit, the stop turns into a market order, and that's the key. It guarantees you'll exit the trade. But in fast-moving markets, it might not be at the price you expected. That's called slippage. And that slippage? It's where your loss grows bigger than planned, especially during a stop hunt. Now, this is where it gets really interesting. Imagine this. A big player nudges the market just enough to trigger a few stops. Those stops become market orders, adding more pressure in the same direction. That triggers more stops, and boom, a cascade. It's like pushing the first domino. Prices move fast. Liquidity floods in. Volatility spikes. What started as a targeted move turns into a full-blown sweep. And while you're thinking it's random movement, institutions are using that surge to enter or exit with precision and profit. Now let's talk about something that gives institutions their edge. Stop-loss clusters. You see, most retail traders, without realizing it, tend to place their stops in the same spots, not because they're copying each other, but because they're all taught the same principles from books, courses, and YouTube videos. And that creates patterns, predictable ones. Let's go through the most common zones, and more importantly, why they attract institutional attention. First, support and resistance levels. These are the most obvious zones. Traders think, if price breaks below support, the trend is invalid. I'll stop out there. But here's the catch. Everyone sees the same support zone. So the area just below it, it becomes a liquidity pool. Institutions know this. They push price slightly below that support, grab the stops, and then reverse it back up. Let's move on. Second, swing highs and lows, swing points like recent peaks and troughs, are visual anchors. Retail traders use them to set stops. Below a recent low in a long trade, above a recent high in a short trade. But again, these points are obvious. Everyone places stops just around them. So what do institutions do? They probe those levels. Just a wick. Just enough. Stops trigger. Liquidity is collected. Still with me? Great. Now here's where psychology plays a sneaky role. Third, round numbers. The power of psychology. Prices like 10,000, 50,000, or 100 even, they just feel important. Traders assume those are strong barriers, so they put stops just before or after them. But the truth, round numbers attract attention. They attract orders, and they attract manipulation. Big players often drive the price just beyond these levels, trigger stops, and then reverse. Let's move to a behavior we've all seen and probably fallen for. Fourth, breakout zones. When price coils into a range, retail traders wait for the breakout. Some place entry orders above resistance or below support. Others place stops nearby in case of a fakeout. Institutions see this. They fake the breakout, sweep both sides, and leave traders stuck in the wrong direction. It's a classic move. And finally, a mistake that screams inexperience. Fifth, arbitrary pip distances. Some traders don't use structure at all. They'll place a stop 50 pips below entry or 100 points above a level, regardless of price action or volatility. These stops, they're easy prey because they don't respect how the market actually moves. Why this matters? These patterns may seem harmless, but when thousands of traders place stops in the same zones, those areas become magnets for price. Institutions don't need to see your stop. They just anticipate where it likely is. And using tools, which we'll discuss soon, they target those zones, trigger the stops, and collect the liquidity. So what looks like a normal candle to you might actually be a carefully calculated sweep. The bottom line is, the more obvious your stop placement, the more likely you'll get hunted. The market rewards patience, awareness, and an understanding of crowd behavior. And now that you know where the crowd hides its stops, you can start thinking a little more like the smart money. Let's now open the door to the real game, the institution's playbook. For institutions, hedge funds, banks, proprietary trading firms, the act of hunting stops is not an emotional or malicious decision. It's strategic. Institutions manage orders so large that simply entering or exiting a position without proper liquidity would move the market against them. This is known as slippage. And when you're managing tens of millions in exposure, slippage isn't a minor inconvenience. It's a threat to profitability. So what's the solution? They look for liquidity clusters, and stop-loss orders from retail traders just happen to be some of the most concentrated, predictable pools of liquidity available. By triggering these stops, institutions create a surge of market orders, which provides the volume they need to execute their own trades with minimal price impact. The goal is not to destroy retail accounts. The goal is to fill large positions efficiently, and retail stop clusters make that possible. Institutions do not fully disclose the inner workings of their trading tools and execution algorithms. Much of their tech stack, data access, and algorithmic behavior is proprietary and protected for competitive and regulatory reasons. So then how do we know anything at all? Through observation, leaked cases, regulatory disclosures, and access to professional-grade platforms, we've been able to piece together a rough map of what powers the institutional engine. Let's break this down into two categories: what's publicly known and what's probably used behind the scenes. Here are the tools available to advanced retail traders that can help infer institutional behavior. Level 2 data/order book depth provides a partial snapshot of real-time bid and ask sizes, useful, though not the full picture. Cumulative volume delta (CVD) tracks aggressive buying versus selling and can reveal whether institutions are absorbing liquidity or driving stop runs. Footprint charts and volume profiles. These show where volume is actually traded, helping spot areas of accumulation, distribution, or manipulation. Liquidity heat maps, bookmap. These tools visualize where orders are likely resting, letting traders anticipate stop clusters and absorption zones. And now, stepping behind the curtain, we enter the world of institutional-level infrastructure and tools that retail traders don't see, but do feel the effects of. High-frequency trading infrastructure, HFT. Co-located servers near exchanges execute trades in microseconds, allowing front-running and order book manipulation far beyond retail capabilities. Smart order routing algorithms. These slice large orders into smaller fragments, adapt in real time to liquidity shifts, and hide the institution's true intent. You don't see the algorithm, but you see its footprints. Internal liquidity models. Institutions use decades of historical data, behavioral patterns, and real-time inputs to anticipate where traders are likely to enter or exit, giving them a predictive edge. Private liquidity pools and dark pools. These allow massive transactions to be executed off the public exchange, completely invisible to retail traders, yet they still affect price flow. The key is this: institutions don't need to see your stop loss. They can infer where stops are likely clustered based on human behavior, technical levels, and real-time market responses. Their tech might be invisible, but its effects, they're right there on your chart. Every time you see a false breakout, a stop run, or a sudden reversal, you're not imagining it. You're watching industrial-grade liquidity engineering in real time. Two of the most well-known forms of market manipulation are spoofing and layering. Spoofing, placing large limit orders to create a false impression of demand or supply, then canceling them before they fill. Layering, doing this repeatedly at different levels to simulate stronger market depth. These tactics manipulate perception. They create the illusion of pressure in one direction, prompting retail traders to enter prematurely or shift stops closer just before a reversal. These are illegal in many jurisdictions, and firms have been fined hundreds of millions of dollars. But in fast, fragmented markets, some of these tactics still occur. Iceberg orders and liquidity absorption. Some tactics, however, are entirely legal, but no less effective. Iceberg orders allow large players to display only a portion of their actual trade on the order book, hiding their true size. Liquidity absorption refers to the gradual execution of massive orders at key levels. By filling against aggressive buyers or sellers, institutions can quietly build or unload positions without creating visible imbalances. These methods are not meant to deceive, but to protect strategy and minimize visibility, especially before or after a stop hunt sequence. Perhaps the most psychologically effective tactic is the false breakout, or what some refer to as an inducement. Here's how it works. The market is pushed just beyond a key technical level, a resistance or support zone, a round number, a Fibonacci level, to trigger stop losses and breakout entries simultaneously. That surge in orders, institutions absorb it. Then the price reverses sharply, leaving stop hunters filled with liquidity and retail traders left chasing shadows. You'll often see this play out in the form of long wicks, sudden spikes in volume, high-speed reversals. Retail traders see a breakout. Institutions see a trap and an opportunity. This may sound manipulative, and in many ways, it is. But from the institutional perspective, this is just liquidity optimization. They don't need to guess. They have the tools. They know your likely behavior, and unless you evolve beyond textbook retail patterns, you're part of the liquidity they're planning to use. The takeaway isn't fear, it's awareness. Understand the game, study the structure, and stop placing your stops where they're easiest to find. Liquidity is the fuel of every financial transaction. Without it, markets don't move. But when it comes to stop-loss hunting, liquidity isn't just a backdrop, it's the target. What is liquidity really? In simple terms, liquidity refers to how easily an asset can be bought or sold without causing a significant change in its price. It's determined by how many active buyers and sellers are in the market, and how much volume they're offering at each price level. But not all liquidity is created equal. Let's break it down. In high liquidity markets, Think S&P 500, Apple, or major forex pairs. There's plenty of volume, tight bid-ask spreads, smooth order execution. Stable prices sound safe, right? Not quite. These environments attract predictable behavior. Retail traders tend to place stop losses at obvious levels, just below support, just above resistance, at swing highs or round numbers. And that's exactly where institutions look for liquidity clusters. Here's how it plays out. Large player aggressively sells to push price below support. Retail long positions get stopped out. Those stops convert into market sell orders. The institution buys into that wave of selling, filling their long position at a discount. Then, just as quickly, price reverses upward, leaving retail traders stopped out and watching the market rally without them. In short, high liquidity creates efficiency, but also predictability, and that predictability makes retail traders vulnerable. Now let's talk about low liquidity markets. These include off-hours trading, like post-market or overnight sessions, Asian session, illiquid assets, like small-cap stocks or exotic currency pairs. Major news event windows, when participants pause orders. In these environments, it doesn't take a large order to move price significantly. That's exactly what makes them ideal for stop-loss hunts. Institutions can push price to stop clusters with smaller capital outlay, trigger cascades with less resistance, widen the spread strategically if they're market makers, cause disproportionate movement with minimal effort. You'll often see flash wicks, sharp reversals, or sudden spikes in low volume times, not because fundamentals changed, but because someone needed liquidity. Now, here's a subtle but important distinction that helps you read institutional intent. Liquidity grab is surgical, a quick, targeted price move into a known cluster of stops. Once filled, the market reverses almost immediately. Liquidity sweep, on the other hand, is broader and more aggressive. Price pushes through several layers of orders, sometimes exceeding expected zones, and is often accompanied by a noticeable volume surge. Both are tools of stop-loss hunting, but understanding the difference helps you decode price behavior. So what's the takeaway for retail traders? Liquidity isn't your enemy, but ignorance of how it's used against you is. If you place your stops in obvious spots, if you trade without knowing when liquidity is thin or thick, you become part of someone else's execution plan. Smart traders respect liquidity dynamics. They don't just look at price. They ask, where is the liquidity? Who needs to fill size here? Is this a grab or a sweep? Because in modern markets, liquidity isn't just flow, it's weaponized. Stop-loss hunting isn't just a retail trader's nightmare. It has ripple effects that stretch far across the market. From increased volatility to broken price discovery, its consequences shape how the entire ecosystem functions. First, let's talk volatility. When stop-loss orders are triggered, especially in cascades, they generate large, sudden price moves. Instead of natural market flow, we get artificial acceleration, sharp reversals, fake breakouts, emotional traps. This creates a double-edged sword, more opportunity, but also more danger. It forces traders to widen their stops, take on more risk, and emotionally endure bigger swings, often playing right into institutional hands. Markets are supposed to reflect real supply and demand. That's what price discovery is all about, finding fair value through honest participation. But when stop hunts, spoofing, and manipulation distort prices, truth gets buried under false moves. Traders get misled. Fair value becomes harder to pinpoint. And instead of rewarding rational decision-making, the market starts rewarding trickery. Now let's zoom out even further. Stop-loss hunting is one form of predatory trading, a strategy that targets traders who are forced to liquidate. In extreme cases, this can create a chain reaction. One trader gets wiped out. Their liquidation adds pressure. That pressure triggers more stops, and suddenly, a routine price drop turns into a market-wide flash crash. This isn't theory. It's happened repeatedly in equities, crypto, and even major forex markets. And the damage goes beyond price. Market confidence drops, legitimate liquidity providers step back, overall efficiency declines. That's how manipulation, meant to exploit the few, can end up destabilizing the many. Now that you understand how institutions view retail traders, and where we often place our stop losses in vulnerable, predictable zones, it's time to explore how we can adapt. While it's impossible to eliminate losses or completely shield ourselves from manipulation, we can become more resilient, more informed, and far less predictable. Let's begin by addressing one of the most overlooked yet crucial tools in the institutional playbook, the VWAP volume-weighted average price. VWAP isn't just another line on the chart. For institutions, it's a compass. It represents the average price an asset has traded at throughout the day, weighted by volume. In simpler terms, VWAP reflects the true market consensus on price. This is why large players constantly refer to it. It helps them determine whether the price is currently expensive or cheap. Understanding VWAP is your first step to thinking like the smart money. When price spikes away from VWAP and then suddenly snaps back, that's often a sign of a liquidity grab, an intentional move to sweep out stop losses before returning to the mean. Moving forward, the placement of your stop loss can mean the difference between survival and slaughter. The mistake most retail traders make is being too obvious. We place stops just below support or just above resistance. We use round numbers. We use standard pip distances. And because we all do it, institutions know exactly where to look. Instead of relying on these predictable levels, traders should start using structure-based and volatility-based logic. One effective method is to use the average true range to assess how far price typically moves. By placing your stop at a distance of, say, 1.5 or 2 times the ATR, you're giving your trade enough room to breathe. The stop now makes sense not only structurally but also statistically. It's no longer low-hanging fruit. Sometimes, volatility spikes. In such cases, slightly widening your stop may protect your position from being taken out prematurely. But this must always be balanced against your risk-reward ratio. You're not just trying to survive. You're trying to survive intelligently. And if the trade setup demands a stop at a popular level, consider splitting your stop. Place part of it at the logical technical zone, and the rest slightly beyond. This way, if the first layer is triggered during a sweep, the second gives you a chance to stay in the game. Some traders prefer to avoid triggering stops altogether by using mental stops, stops they watch manually but don't place on the chart. While this may offer some protection from being hunted, it requires intense emotional discipline. There's no safety net. If you're not confident in your reaction speed and self-control, this can be a dangerous game. But the most powerful strategy is not where you place your stop. It's where you place your attention. Smart traders watch for institutional footprints. These signs are often hidden in price action. A sudden wick piercing a key level. An explosive volume spike. A rejection that seems too perfect. These are often signs that a liquidity pool has been swept and that institutions may be reversing direction. Order blocks and fair value gaps, concepts often discussed in smart money trading, also play a key role. Order blocks are zones where institutions have previously placed significant trades. Fair value gaps are the imbalances left behind by rapid moves. Both often serve as magnets for price action. When these zones align with VWAP or volatility levels, you have a confluence worth watching. The trick is to wait, not to chase. Let the market come to you. Wait for the manipulation to finish. Let the sweep happen. And then, once the reaction confirms the trap, that's your opportunity. You're no longer reacting. You're participating on your terms. Diversification and hedging can protect your broader portfolio from unexpected events, but ultimately, the most effective hedge is your mindset. You have to stop thinking like prey. The goal is not just to avoid being hunted. It's to stop walking blindly into the trap. Start thinking like the hunter. Ask, where would smart money expect the average trader to place their stop? What would they do next? The more you ask this, the closer you get to anticipating, not reacting. And finally, never stop refining. Backtest your trades. Keep a journal. Observe how far price moves past your entry before it goes in your favor. Study how it behaves around VWAP. Learn the rhythm. Once you can read the rhythm, the manipulation becomes predictable. And when manipulation is predictable, it becomes opportunity. This is how you stop being the hunted. This is how you trade like you belong in the deep waters, right alongside the sharks. Conclusion. You've just stepped behind the curtain, seen how institutions think, how they hunt, and how they move the market with precision. But now, you're not just another stop on their path. You're informed. You're intentional. You're evolving. Remember, the goal isn't to beat the smart money at their own game. It's to stop playing the game blind. By understanding how liquidity works, how stop losses are exploited, and how to place yourself outside the obvious, you become less of a target and more of a tactician. Trading will always be a battle, but now you're not just reacting, you're anticipating. And that shift, Right there is the beginning of real power. Stay sharp, stay strategic, and never trade like prey again.